Advanced Audit and Assurance, Chapter 14, Reporting, Section 4.4, Other Matters Paragraph. As stated above, an other matter paragraph is used if the auditor considers it necessary to communicate a matter other than those included in the financial statement that, in his opinion, is relevant to users' understanding of the audit, and the auditor's responsibilities or the audit report. In this case, the auditor is required to include the other matter paragraph immediately after the opinion paragraph, and any emphasis of matter paragraph or elsewhere in the report if its content is relevant to the other reporting responsibilities section. Once again, the inclusion of an other matter paragraph does not modify the opinion. Circumstances in which an other matter paragraph may be necessary. ISA 706 gives the following examples of circumstances in which an other matter paragraph may be necessary: where the auditor is unable to resign from their engagement even though the possible effect of a limitation of scope imposed by management is pervasive. This should be rare in practice. Where local law or custom allows the auditor to elaborate on his responsibilities in his report. If revision of other information issued with audited financial statements is considered necessary by the auditor, but management refuses to make the revision. Section 4.5, the modified opinion, ISA 705. When the auditor must issue a modified opinion. ISA 705 modifications to the opinion in the independent auditor's report requires the auditor to modify his opinion in the audit report in two situations. 1. Material misstatement. This occurs when the auditor concludes that, based on the audit evidence obtained, the financial statements as a whole are not free from material misstatement. In other words, the auditor considers that there is a material misstatement in a financial statement. 2. Limitation on scope. This occurs when the auditor is unable to obtain sufficient appropriate evidence to conclude that the financial statements as a whole are free from material misstatement. In other words, the auditor has been unable to obtain sufficient appropriate audit evidence to reach an opinion that the financial statements give a true and fair view. Therefore, the financial statement may contain a material misstatement. ISA 705 lists three types of modified opinions. 1. A qualified opinion. 2. An adverse opinion. And 3. A disclaimer of opinion. Each of these types of modification is explained below. Deciding the type of modified opinion required. The following table from ISA 705 provides a useful summary of when each type of modified opinion is required to be given in the audit report. Nature of matter giving rise to the modification. Auditor's judgment about pervasiveness of the effect or positive effect on the financial statement. Material but pervasive. Material and pervasive. So those are the nature of matter giving rise to modification. Nature of matter giving rise to modification could be material but not pervasive, and it could be material and pervasive. Financial statements are materially misstated. So when financial statements are materially misstated, we have qualified opinion under material but not pervasive. But under material and pervasive, we have adverse opinion. That's when your financial statements are materially misstated. Inability to obtain sufficient appropriate audit evidence that is limitation of scope, we have qualified opinion under material but not pervasive, and we have disclaimer of opinion under material and pervasive. Qualified opinions. A qualified audit opinion should be given when, in the opinion of the auditor, there is a material misstatement or a limitation on scope, and the effect on the financial statement is material but not pervasive. Qualified audit opinions are sometimes called except for opinions because the audit report should state that, in the auditor's opinion, the financial statement gives a true and fair view except for the matter or matters described in the report. The meaning of pervasive: disclaimer of opinion or adverse opinion. Generally, a matter will be material but not pervasive when the auditor encounters a material Generally, a matter will be material but not pervasive when the auditor encounters a material problem with one or more specific items in the financial statement, such as a problem with inventory or revenue, but the remaining items and the financial statement as a whole provide a true and fair view. Pervasive effects on the financial statement are defined by ICAN 705 as those that, in the auditor's judgment, are not confined to specific elements, accounts, or items of the financial statement, or are confined to specific elements in the financial statement, but these represent or could represent a substantial proportion of the financial statement, or, in relation to disclosures in the financial statement, are fundamental to users' understanding of those statements. The difference between a material and a pervasive modification is a matter of judgment. There are no absolute cut-off points or dividing lines that separate one from the other. Limitations on scope. ICAN 705 suggests that a limitation on scope may occur as a result of 1. Circumstances beyond the control of the entity, such as when the entity's accounting records have been destroyed. 2. Circumstances relating to the nature of timing of the auditor's work. An example is when the auditor is appointed too late to enable him to attend the physical inventory count. 3. Limitations imposed by management. The management of the client entity may prevent the auditor from obtaining the audit evidence required, for example, by preventing the auditor from observing the physical inventory count, preventing the auditor from asking for confirmation of specific account balances, for example, a receivables of secularization. Management imposed limitation on scope. If after accepting the engagement, the auditor becomes aware that management has imposed a limitation on the scope of the audit, which is likely to result in a qualified or disclaimer of opinion, the auditor is required to ask management to remove the limitation. If management refuses to do this, the auditor must communicate the matter to those charged with governance. Consider whether it is possible to perform alternative audit procedures in order to obtain sufficient appropriate audit evidence. If it is not possible to obtain audit evidence in another way, and the matter is material but not pervasive, the auditor must give a qualified opinion. If it is not possible to obtain audit evidence in another way, and the matter is material and pervasive, the auditor must resign from the audit where practicable and not prohibited by law or regulations, or, if not practicable or possible, issue a disclaimer of opinion. Section 4.6. Form and content of a modified opinion. The form and content of a modified audit report with a modified opinion differs from an unmodified audit report in several ways. ISA 705 includes the following requirements. Basis for modified opinion paragraph. When a modified opinion is issued, the audit report must include a basis for opinion paragraph, which should appear just before the audit opinion in the report. The paragraph is headed Basis for qualified opinion, Basis for adverse opinion, or Basis for disclaimer of opinion, as appropriate. Examples of these types of opinion are shown later. This basis for opinion paragraph must include the following. 1. For a material misstatement relating to specific amounts, a description and quantification of the impact on the financial statement, or a statement that quantification is not possible. 2. For a material misstatement relating to narrative disclosures, an explanation of how the disclosures are misstated. 3. For a material misstatement relating to the non-disclosure of information that should have been disclosed, the nature of the omitted information, and unless prohibited by law or regulation, the omitted disclosures. 4. If the modified results from an inability to obtain sufficient appropriate audit evidence, the reasons for that inability. Opinion paragraph. This paragraph in the audit report must be headed Qualified opinion, Adverse opinion, or Disclaimer of opinion as appropriate. Specific wording is prescribed for the different types of modified opinion, which are best illustrated by the examples shown later. Auditor's responsibility paragraph. The auditor's responsibility paragraph appears earlier in the audit report, after the statement about management responsibilities for the financial statement. For a qualified or adverse opinion, this paragraph is amended to state that the auditor believes that the audit evidence obtained is sufficient and appropriate to provide a basis for the modified opinion. Where the auditor gives a disclaimer of opinion, more extensive amendments are required by ISA 705. Section 4.7. Examples of modified opinions. Illustrative examples of the different types of modified opinions are shown below. They are all taken by ISA 705. Where paragraphs in the examples are incomplete, the wordings of the report commences or concludes in the same way as in the example of the unmodified reports, shown in an earlier section of this chapter. Example 1. Qualified opinion. Limitation on scope. This is an example of a qualified opinion arising from the auditor's inability to obtain sufficient appropriate audit evidence. The only paragraph from the reports that are shown here are those that are relevant to the modified opinion. Auditor's responsibility. We believe that the audit evidence that we have obtained is sufficient and appropriate to provide a basis for our qualified audit opinion. Basis for qualified opinion. ABC company's investment in XYZ company, a foreign associate acquired during the year and accounted for by the equity method, is carried at X naira on the statement of financial position at 31 December 2004. An ABC share of XYZ net income is included in ABC's income for the year then ended. We were unable to obtain sufficient appropriate audit evidence about the carrying amount of ABC's investment in XYZ at 31 December 2004 and ABC's share of XYZ's net income for the year because we were denied access to the financial information. Management and the auditors of XYZ. Consequently, we were unable to determine whether any adjustment to this amount were necessary. Qualified opinion. In our opinion, except for the possible effect of the matter described in the basis for qualified opinion paragraph, the financial statements give a true and fair view. Example 2. Qualified opinion, material misstatement. This is an example of a qualified opinion arising from a material misstatement of the financial statement. Auditor's responsibility. We believe that the audit evidence that we have obtained is sufficient and appropriate to give a basis for our qualified audit opinion. Basis for qualified opinion. The company's inventories are carried in the statement of financial position at X naira. Management has not stated the inventory at the lower of cost and net realizable value, but has stated them solely at cost, which constitutes a departure from international financial reporting standards. The company's records indicates that had management stated the inventory at the lower of cost and net realizable value, an amount of X naira would have been required to write the inventories down to their net realizable value. Accordingly, cost of sales would have been increased by X naira, and income tax, net income, and shareholders' equity would have been reduced by X naira, and X naira respectively. Qualified opinion. In our opinion, except for the possible effects of the matters described in the basis for qualified opinion paragraph, the financial statements give a true and fair view. Example 3. Disclaimer of opinion, limitation on scope. This is an example of a disclaimer of opinion where the auditor has been unable to obtain sufficient appropriate audit evidence about a single element of the financial statement. This is an example of a disclaimer of opinion where the auditor has been unable to obtain sufficient appropriate audit evidence about multiple elements of the financial statement. We were engaged to audit the accompanying financial statement of ABC Company. Management is responsible for ... Auditor's responsibilities. Our responsibility ... International standards on auditing. Because of the matter described in the basis for disclaimer of opinion paragraph, however, we were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Basis for disclaimer of opinion. We were not appointed as auditors of the company until after 31st December 20x4 and thus did not observe the counting of physical inventories at the beginning and ending of the year. We were unable to satisfy ourselves by alternative means concerning the inventory quantities held at 31 December 20x3 and 20x4, which are stated in the statement of financial position at X naira and X naira respectively. In addition, the introduction of a new computerized accounts receivables system in September 20x4 resulted in numerous errors in accounts receivable. As of the date of our audit report, management was still in the process of rectifying the system deficiencies and correcting the errors. We were unable to confirm or verify by alternative means accounts receivable included in the statement of financial position at a total amount of X naira as at 31 December 20x4. As a result of these matters, we were unable to determine whether any adjustment might have been found to be necessary in respect of recorded or unrecorded inventories and accounts receivables, and the elements making up the income statement, statement of changes in equity, and statement of cash flow. Disclaimer of opinion. Because of the significance of the matter described in the basis for disclaimer of opinion paragraph, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on the financial statement. Example 4. Adverse opinion, material misstatement. There is an example of an adverse opinion. Example 4, adverse opinion material misstatement. This is an example of an adverse opinion is of a group audit report. Auditor's responsibility. We believe that the audit evidence that we have obtained is sufficient and appropriate to provide a basis for our adverse audit opinion. Basis for adverse opinion. As explained in Note X, the company has not consolidated the financial statements of subsidiary XYZ company it acquired during 20X4 because it has not yet been able to ascertain the fair value of certain of the subsidiary's material assets and liabilities at the acquisition date. This investment is therefore accounted for on a cost basis. Under International Financial Reporting Standards, the subsidiary should have been consolidated because it is controlled by the company. Had XYZ been consolidated, many elements in the accompanying financial statement would have been materially affected. The effect on the financial statement of the failure to consolidate have not been determined. Adverse opinion. In our opinion, because of the significance of the matter discussed in the basis for adverse opinion paragraph, the consolidated financial statements do not give a true and fair view. Section 4.8. Deciding to give a modified opinion. The auditor will give a modified opinion only if he is satisfied that the reasons for giving a modified opinion are justified and the management of the client entity are unable or unwilling to take action to remove the necessity for a modified opinion. For example, suppose that the management of a client entity decides that a material non-current asset should not be depreciated. The auditor should first of all satisfy himself that there is no acceptable reason for the management's view and that the asset should be depreciated. The auditor should review the audit file and check for any information about this matter from previous audit. He should consider whether there might be an acceptable reason for a departure from the requirements of International Financial Reporting Standards and GAAP in order to give a true and fair view. If the auditor is still satisfied that management is incorrect in their opinion, it should meet with the management and discuss their reasons for not depreciating the asset, obtain a representation from them confirming that the asset will not be depreciated, decide whether the effect of this action by management on the financial statement is material and pervasive, and so what form of modified opinion is necessary. Warn management that the audit opinion will be modified unless management change their view. If management still refuses to change their view, issue a modified opinion, which will be either a qualified opinion or an adverse opinion. Section 4.9. Audit reports and the exam. For the exam, you may be expected to study an audit report that contains error and identify and explain what those errors are. Alternatively, you may be asked to discuss what audit opinion would be appropriate in a particular situation. The key issues to consider are as follows. 1. Do the financial statements give a true and fair view? Remember, misstatements do not affect the true and fair view if they are immaterial. 2. If they do, the audit opinion will be unmodified. If the draft financial statements give a true and fair view, is there any item that justifies an emphasis of matter paragraph? Usually, an emphasis of matter paragraph is something that could affect the going concern assumption. If the financial statements do not give a true and fair view, what is the item or contention? Is it something that involves a disagreement with management? or is there inadequate audit evidence? That is a limitation on scope. Is the matter material but not pervasive? If so, a qualified audit opinion is appropriate, except for if the matter is material and pervasive, either an adverse opinion or a disclaimer of opinion is appropriate. These are rare in practice, but of course they could feature in an exam question. Here are some examples. Example 1. You are the manager in charge of the audit of Coloroso, a limited liability company. Your auditor's report for the previous financial year to 31 December year 7 was signed without modification. In February year 8, the scope of the audit for the year to 31 December year 8 has been limited. This is because the company's chief executive officer fled the country in April year 8, taking the accounting records with him. You have identified a valuable training opportunity for Robin, one of your audit team. As a training exercise, you have asked Robin to draft the extract for the basis of opinion and opinion paragraphs that would not be standard wording in an unmodified auditor's report. Robin's draft extracts were produced as follows. Basis of opinion extract. However, the evidence available to us was limited because accounting records were missing at the beginning of the year and it was not possible to reconstruct them completely. Opinion extract. Because of the possible effect of the limitations in the information available to us, we do not express an opinion on the financial statements. Requirements. A. Identify and comment on the principal matters relevant to forming an appropriate opinion on the financial statement of Coloroso for the year ended 31 December year 8. B. Discuss the suitability of Robin's draft extract. Answer. Tutorial notes. To answer these requirements, you need to 1. Identify the principal matters relating to forming an appropriate opinion. Comment on these matters. Identify whether Robin's report indicates that Robin has identified and considered these matters. Reach a conclusion about whether Robin's report is suitable. This may involve setting out what would have been suitable if Robin's report is not suitable. Matters relevant to forming an opinion. The following matters are relevant to forming an appropriate opinion. 1. The accounting records for the opening 3 or 4 months of the year are missing. The accounting records are missing because the former CEO absconded with them. There must be some reason why he took the accounting records. Fraud is a possible reason. 3. The audit opinion for the previous financial year was unmodified. This would imply that the opening balances for the current year and comparative figures for the previous years are correct. However, this might not be the case. 4. If there is a possibility of fraud, this would raise doubt about the correctness of the audit report for the previous year. There may have been fraud last year that was undetected fraud, and this might have caused material misstatements to that audit report. 5. There is an inability to obtain sufficient appropriate audit evidence, limitation on scope for the year to 31 December year 8. Comment on these matters. Matters listed above. Comments. For matter 1, comment. This constitutes a limitation on the scope of the audit. Item 5. The auditors will not be able to obtain sufficient appropriate audit evidence about the relevant period. Therefore, the audit opinion will be modified. The modification should A. Give details of what records are missing and why, or B. Cross-refer to where this information is given in the financial statement. The extent of the modification will depend on which records are missing and where the auditor's scope is limited. It is likely that the information with regard to the income statement or statement of comprehensive income is limited, but possibly not the statement of financial position. A modification might be limited to a qualification except for over the statement of comprehensive income for the first few months of the year. Matter 2. However, there is an indication in the manner in which the CEO has taken the accounting records that there may have been a fraud. It is therefore probable that the auditors will have to modify the opinion even if they are able to reconstruct the financial statements, as it will not be possible to gain sufficient appropriate evidence about the possible fraud. Matter 3 and 4. The previous audit reports cannot be withdrawn, but the auditors are not precluded from modifying their opinion for the current year on the basis of the comparative figures for the previous year. It is probable that any fraud in progress at the start of this financial year could have affected the previous financial year, unknown to the auditors at the time. Conclusion about Robin's draft. Robin is correct to modify the opinion on the ground of limitation of scope. However, the draft should make reference to the exact nature of the problem or possible fraud, take account of a possible modification in relation to the comparative figure for the previous financial year, take account of the fact that the problem may be limited to the statement of comprehensive income. Example 2. A client has recently prepared draft financial statements for the year to 31 December year 2. During the year, the company closed a factory that made a loss-making product which contributed 14% to total sales revenue in the previous year and 10% in the current year. The closure is permanent. It is mentioned in the director's report and in the annual business review, but not in the financial statements themselves. Required. What should be the auditor's view of this situation? Answer. The factory appears to have been a separate component of the company's business, making a separate product that contributes materially to total assets, to total sales income. The closure represents a discontinued operation, and failure to disclose the details is a failure to comply with IFRS 5, non-current assets held for sale and discontinued operations. It is also in breach of the requirements of IAS 7, Statement of Cash Flow, and IFRS 8, Operating Segment, which also require disclosures relating to discontinued operations. The matter is material, but is not pervasive. If management do not amend the financial statements to provide the required disclosures, a qualified audit opinion for a misstatement would be appropriate. Example 3. A client company has prepared draft financial statements for the year to 31 December year 3. In February year 4, a legal claim was made against the company, claiming substantial damages. The company's lawyer have advised that the claim has less than 50% chance of success. If it did succeed, the company would have sufficient cash resources to meet the claim in full. The matter is disclosed in the draft financial statement in a note as a material contingent liability. Required. Should the audit opinion be unmodified, and if so, should the report contain an emphasis of matter paragraph? Answer. The claim was made after the end of the reporting period and is a non-adjusting event. The probability that a claim will be successful is less than 50% on the assumption that the lawyers have given a reasonable opinion. It is therefore appropriate to disclose the item as a contingent liability. In this case, a material non-adjusting event after the reporting period. The auditor should therefore give an unmodified opinion. An emphasis of matter paragraph is normally only used when the matter involves considerable uncertainty. Considerable uncertainty usually exists only when there is some concern about the going concern status of the entity or about a matter that could have a major impact on the financial statement. In this case, we are told that the company has sufficient cash resources to meet the legal claim in full in the event that it is successful. It therefore appears that considerable uncertainty does not exist, and an emphasis of matter paragraph would be inappropriate. Subtopic 5. Other information published with the audited financial statement. ISA 720. Section Overview. The nature of other information. ISA 720. Other information in documents containing audited financial statements. Section 5.1. The nature of other information. The published annual reports of major companies obtain a significant amount of information that is not required by statute or by accounting standards. The annual financial report is often used partly as a public relations document, communicating a wide range of information from the company to shareholders and others, possibly in a report from the chairman or the chief executive officer. If you have not done so already, you should read the published reports and accounts of several public companies that have adopted international accounting standards and look at the information that they include. Published reports and accounts are normally available from the company's website, often in the Investor Relations section. In doing this, you should note the following: the scope and content of the report, in particular, what non-financial information is published, the comments and reports on corporate governance matters. It would also be helpful for your auditing studies to look at the form and content of the audit reports, the accounting policies applied, any accounting or auditing problems that may be evident from the financial statement. Section 5.2, ISA 720, Other information in documents containing audited financial statements. One of the main benefits of the audit process is that audited information possesses a higher degree of credibility and reliability than equivalent information that has not been audited. There is a possibility that the credibility of audited information may suffer if information that has not been audited is published together with audited information, often in the same printed document, and the unaudited information contains error or is inconsistent with the audited information. The audit report makes it clear what information has been subject to audit. However, there is a high risk of misunderstanding and a possibility that users of the financial statement will not make the distinction between audited information and other information. For this reason, ISA 720 requires that auditors should read this other information in order to identify material inconsistencies with the audited financial statement or material misstatement of facts. An inconsistency exists when the other information contradicts information contained in the audited financial statement. A misstatement of fact exists when the other information is incorrectly stated or presented, but the information is not related to matters in the audited financial statement. Action if inconsistencies are not removed. If the auditor judges that financial statements need to be revised and management refuse to do so, then the auditor should qualify his audit opinion. If the auditor judges that the other information needs to be revised and management refuse to do so, then the auditor should include an other matter paragraph in his audit report or withhold his audit report or, where allowed by law, withdraw from the audit. If a material inconsistency is identified after the date of the auditor's report, the auditor should follow the provision of ISA 560 subsequent events. Action if misstatements are not removed. If the auditor becomes aware of an apparent material misstatement of facts, he should 1. Discuss the matter with management, and if he considers that there is an apparent material misstatement of fact, request management to take legal advice and consider the legal advice received by the entity. If the auditor concludes that there is a material misstatement of fact which management refuses to correct, it should 1. Notify those charged with governance, and 2. Take any further appropriate actions such as taking legal advice about the matter.